Before we get into prices this morning, here's the big picture. The markets aren't loud right now, but they are talking. Corn is plummeting, wheat is quietly strengthening, soybeans are still under pressure, and livestock is trying to decide whether this rally has another leg or needs to catch its breath. None of these moves are accidents, and if you're producing crops or livestock in 2026, what's happening right now matters more than it looks on the surface. Stick with me. We'll break down the markets, the weather, and the ag news that could shape decisions later this year. Good morning and welcome to Boots and Bushels, your daily look at the markets that feed America. Whether you're watching this with a cup of coffee, listening on the road, or catching it later in the day, thank you for spending your morning with me. Let's start with how the markets settled, then we'll dig into weather and the ag news producers need to hear today. Let's start with the grain markets, where price action continues to feel cautious but intentional. Corn futures settled with the March contract near 421 per bushel. Corn continues to trade in a tight range, and that tells us the market is comfortable. Not excited, but not worried either. Ethanol demand remains steady, feed usage hasn't disappeared, and export interest is just strong enough to keep corn supported. What corn doesn't have right now is urgency, and until that shows up, this market is likely to keep grinding instead of running. Soybeans remain the weakest piece in the grain complex. January beans settled near 1033, March around 1049, and May near 1062. The weight of the South American production is still pressing on this market, and traders continue to trade rally. American production is still pressing on. The weight of South American production is still pressing on this market, and traders continue to fade rallies. Meal demand has helped slow the downside, but beans are still searching for a reason to turn higher. Right now is a market that's reacting, not leading. Wheat continues to quietly outperform. March wheat settled near 511, May around 523, and July near 536. Wheat doesn't need a big headline to move. It just needs steady concern, and that's exactly what it has. Global supply questions, geopolitical uncertainty, and weather risk are keeping wheat relevant even when other grains struggle. Rice futures remain firm, trading near $20 per hundredweight. Rice continues to be supported by tight supplies and limited producer selling, and unlike other grains, is not seeing heavy pressure from global competition. Sunflower markets remain thin but supported, reflecting limited acreage and steady demand. Potatoes remain a regional cash-driven market. Supplies remain uneven, with pricing still dependent on location, contract structure, and processing demand rather than future speculation. Cotton futures remained under pressure, trading in the mid to upper 70-cent per pound range. Cotton continues to fight sluggish export demand and global textile uncertainty. And until that changes, rallies are likely to be capped. Livestock markets are still historically strong, but the tone is shifting slightly. Live cattle futures are trading around 235 per hundredweight. Supplies remain tight, and that's still the backbone of this market. However, traders are starting to ask how much demand can absorb these levels. The market isn't breaking, it's pausing, and that's an important distinction. Lean hog futures settled with nearby contracts trading roughly in the mid 80s to low 90s. Hog producers continue to battle tight margins, but recent price stability suggests the market may be finding balance, at least for now. Class 3 milk futures are holding near 1750 per hundredweight. Dairy markets remain sensitive to feed cost and consumer demand, and while prices aren't exciting, they are holding together better than many expected late last year. Weather remains mostly quiet, and that's contributing to the sideways tone in the markets. Across the Corn Belt, typical January cold continues, but there are no widespread extreme weather threats at this time. Snow cover remains uneven, which is worth monitoring for winter wheat protection in parts of the plains. In South America, Brazil continues to see mostly favorable growing conditions. which is reinforcing confidence in soybean production. Argentina remains drier in pockets, but conditions have not deteriorated enough yet to force a major market reaction. For now, weather is a background factor, not the headline, but that can change quickly. Let's spend some time on the ag news shaping the broader picture. One of the biggest stories hitting grain markets today came straight out of the USDA. Explains why corn futures were hit so hard. In today's USDA reports, including January WASDE crop production summary and grain stocks, the government surprised the market with a much larger U.S. corn supply than traders were expecting. The headline number that caught everyone's attention was total U.S. corn production being pegged north of 17 billion bushels, which is an eye-opening figure by any historical standard. The USDA raised corn production by increasing yield estimates, not because acres suddenly exploded, but because they're saying the crop simply produced more than previously believed. Yields were adjusting higher, and when you multiply even a small yield increases across millions of acres, you end up adding a lot of bushels to the balance sheet. At the same time, ending stocks were raised, which tells the market something important. Demand is not keeping pace with supply. Even with steady ethanol usage and consistent feed demand, the USDA does not believe exports or domestic usage are strong enough right now to absorb all those extra bushels. That combination, more production and higher ending stocks, is exactly what futures markets are most sensitive to. And that's why corn sold off sharply. March corn futures dropped nearly 25 cents per bushel from Friday's close to today's settlement. Not because demand disappeared overnight, but because the supply picture suddenly got heavier. The market had been leaning on the idea that supplies were manageable. Today's USDA numbers pulled that rug out from under it. It's also important to understand the psychology. Traders don't just react to the numbers, they react to how different those numbers are from expectations. This report was viewed as bearish relative to what the market was positioned for, and when that happens, funds move fast. That's where a good chunk of today's selling pressure came from. Now, stepping back for producers, this doesn't mean corn is suddenly worthless or that demand has collapsed. Ethanol margins are still workable, feed demand is still there. What it does mean is that the market is being forced to reprice corn in a world where supplies look more comfortable than expected. Going forward, the market will be watching export sales very closely. If demand improves, it can help slow or stabilize this move. If demand stays sluggish, rallies may be harder to sustain. But for today, the story is simple. The USDA added bushels, the market didn't like it, and corn paid the price. Export competitiveness remains a major concern, especially for soybean. U.S. export shipments continue to trail where the market would like them to be, and South America is aggressively filling global demand. Until that balance shifts, soybeans will struggle to lead the grain complex higher. Farm input costs are still reshaping decision making. Fertilizer, feed, fuel, and interest rates remain elevated enough that producers are watching every dollar closely. Even with strong livestock prices, margins are thinner than they appear on the surface. Equipment manufacturers are signaling caution. Production slowdowns, workforce reductions, and conservative outlooks suggest companies are preparing for a slower equipment cycle in 2026. That doesn't mean farming is in trouble. It means businesses are adjusting to tighter cash flow and higher borrowing costs. Policy discussions are quietly gaining momentum. Trade policy, transportation infrastructure, and risk management tools are back in focus as lawmakers return to Washington. While nothing concrete is passed yet, the direction of these conversations could influence exports, import costs, and rural investments later this year. Finally, producer sentiment is mixed. There's optimism around strong livestock prices and stable grain floors, but concern about rising costs and global competition. That combination is creating cautious behavior, fewer big bets, more risk awareness, and a strong focus on staying flexible. So as we start this week, the markets aren't shouting, they're signaling. Corn is down and wheat is holding. Soybeans are under pressure. Livestock remains historically strong but watchful, and weather is calm for now. That's today's Boots and Bushels market update. If this breakdown helped you, make sure to like, subscribe, and share it with someone who follows the markets too. Thank you for spending your morning with Boots and Bushels. Keep your boots muddy and your bins full, and I'll be back here tomorrow morning.